Hey everyone, today the mutual fund market of India is bombarded with hundreds of mutual funds across categories, and it really gets very confusing to choose the right mutual funds. Now I frequently get this query to share top mutual fund names where you can set up SIP that can take care of your retirement planning. So today I'm going to discuss the best mutual fund where you can set up an SIP that will take care of not just your retirement planning but all your financial goals including child education. Alright, let's get started. So let's first start by answering this question. What do you look for while selecting a mutual fund for retirement planning? Well, I'm sure the most important parameter is returns. At the end of the day, we all want to maximize our returns on investment. As a result, majority of retail investors select a mutual fund based on its past performance. The simple criteria is to shortlist mutual funds with the highest return over the last 1 to 3 years. But there's a catch. There's no guarantee that the mutual fund that has generated the highest return in the past would continue to generate the highest return in the future. Now imagine, you start investing your money in 2-3 mutual funds based on great return in the past, and eventually over the next say 3 years, they start underperforming. And when you check the performance, you find that now there are different mutual funds among top performers in the last 1 to 3 years, and your mutual funds are underperforming. I'm sure many of you watching this video would have come across a situation where some of the mutual funds in your portfolio have underperformed, and you would be confused what to do with them. Sell them, hold them, or continue the SIP. Well, this is the biggest challenge of investing in active mutual funds. While some active funds will always outperform the benchmark, the challenge is that there's no guarantee that the mutual fund where you have invested your money would continue to outperform. In fact, it's not just me who is saying this. Even there was a report published by SPIVA India for year end 2023 that suggested around 73% active mid and small cap funds failed to beat benchmark in 2023. This is despite such a huge rally in the market, and 52% large cap active funds underperformed the benchmark in 2023. Now this slide gives a clear picture. It shows the performance of active funds within large cap category, ELSS, mid and small cap, composite bonds and government bonds across 1 year, 3 year, 5 year and 10 year duration. Let's focus on large and mid small cap. So for large cap in 1 year period, 52% active funds have underperformed the benchmark. It means every second active mutual fund has underperformed. Within mid and small cap category, 73% active mutual funds have underperformed in 1 year. That's almost 3 out of 4 active funds that underperformed. What is the guarantee that you will have only those 27% funds in your portfolio that outperform? In fact, the situation is even worse for long-term period. Within large cap, more than 80% active mutual funds have underperformed the benchmark over 3 year and 5 year period. That's crazy. And more than 60% underperformed over 10 year period. Within mid and small cap, almost 60% active funds underperformed over 3 year and 5 year period, and more than 70% active mutual funds have underperformed over 10 year period. Now this is an alarming situation. Then another problem with active mutual fund is during bull rally, when you filter the funds by performance, you will see all small cap and mid cap funds generating huge return and large cap lagging in terms of return. As a result, majority of retail investors end up having very high exposure in mid and small cap mutual funds. That's exactly the situation today. Nobody wants to have exposure in large caps. Everyone wants to invest in mid and small cap. But I always say that it's not just about returns. It's about risk adjusted returns. While mid and small cap mutual funds are looking very attractive today, they are also very volatile category. It means when there's a correction, mid and small cap falls the most. It has happened multiple times in the past. I clearly remember 2018 to 20 period when the mid and small cap index tanked badly and nobody wanted to invest in these categories. Today, everyone wants to invest only in mid and small cap funds. I'm sure when there will be a correction, many people would again want to switch to large caps. Now, I'm not saying that mid and small cap category is bad. All I'm trying to say is it's very important to have a balance across large, mid and small cap. During bull rally, while mid and small cap outperform the large cap, during bear market, they also fall the most. It means net there won't be a significant difference in terms of return across your large, mid and small cap. For instance, if you look at last 20 years of index of large, mid and small cap, you would see that Nifty 50 has generated around 14 to 15% return. Mid cap index has generated 16-17% return and small cap index has generated 17 to 18% return. And that is after the exponential rally in mid and small cap index in last few years. When there will be correction, this gap would narrow down. Hence, in the long term, there would be a small difference in the performance of large, mid and small cap. So in this discussion, we have established two things so far. First, in the long term, the difference between return across large, mid and small cap is not very significant. Small and mid cap returns are certainly a bit higher than large cap, but they are also very volatile. So it can be very painful to hold them during difficult times. And you should always look at both risk and return. Don't just look at returns only. And second thing, over the long term, majority of active mutual funds struggle to beat the benchmark across large, mid and small cap. Today's top performance in active mutual fund category may not remain the top performance in the long run. Then you would be wondering why majority of people end up investing in active mutual funds, especially in mid and small cap mutual funds. There's only one reason. That's because of greed. Majority of people don't like boring investments. They want a thrill, and they get this thrill in active mutual fund category, especially in mid and small cap, because there's a chance that active mutual fund can generate higher returns for them. Although the data suggests that in the long run, majority of active mutual funds struggle to beat the benchmark. But even if there's a minute chance of outperformance, people like to take that chance. Although it's not that index funds are not getting popular. In fact, index funds are gaining popularity big time in India. As per recent data of August 24, passive mutual funds have crossed an AUM of 10 lakh crore rupees. Wow. Although it's still much lower than active mutual fund AUM, which is around 50 lakh crore. But if you look at the growth rate, 5 years ago, passive mutual funds had an AUM of just 1.77 lakh crore. So within 5 years, passive index AUM has grown almost 6 times. And going forward, passive mutual funds AUM is expected to touch levels of 25 to 30 lakh crore by 2030. That would be 25 to 30% of the total mutual fund AUM. So considering all these factors, how do you shortlist the best mutual fund for long-term goals like retirement planning, child education, etc.? That's where the answer is index funds. Please note that I'm not completely against active mutual funds. In fact, there are many good funds in the market. But my research suggests that for a person with long-term financial goal, the core portfolio should have index funds. Then you can always have a couple of active funds from, let's say, flexi cap category, where the fund manager would decide the allocation across large, mid and small cap based on market situation. Or you can even consider, let's say, mid cap or small cap fund. But the majority of your money should go to an index fund. As far as individual stock investment is concerned, while it can be very rewarding, it also requires a lot of knowledge, research, patience, conviction and experience that majority of people lack. Hence, for a person who has started his or her investment journey, you can keep a small allocation in individual stock as well and slowly build knowledge. And once you gain confidence, you can increase your stock allocation. Personally, I did the same thing. I started with majority of my money in mutual funds, and now I have shifted majority of my money to individual stocks as I gain knowledge and experience. Plus, I spend nearly 8 to 10 hours a day in my research. So in case you want to invest in individual stocks and looking for guidance, you can explore my weekly video series where I share one exclusive video every week that include my top conviction bet where I'm investing my own money for long-term wealth creation along with reason behind the same. Plus, I track the quarter results of more than 200 companies that really help in identifying potential multi-baggers. For more details, you can explore my website or join button of this channel. Now moving on, the question is, which is the best index fund for long term? This takes us to the second part of this video. Okay, first of all, let's try to understand the benefits of investing in index fund. So first benefit is low cost investing. Index funds have a very low expense ratio of 0.1% to 0.2% versus active mutual fund expense ratio that hovers in the range of 0.5 to 1.5%. That too for direct mutual fund. Regular funds have even higher expense ratio due to mutual fund agents' commission. While this difference in expense ratio may look very small, this is one of the major differentiator why active funds struggle to beat the benchmark. Because 1% of difference every year in terms of fee can change the entire game. Second reason why I like index fund is market link performance. Since index fund replicate the entire market as per the weightage of the company in terms of free float market cap, the performance is completely linked to the market. The best part is index funds are dynamic in nature. It means if a company underperforms, it gets removed from the index and outperformer gets an entry into the index. So you don't have to worry about the index performance. If you are confident of India's growth story, index funds are the best representation of that growth story. Now the catch is, there are various categories within index fund. Nifty 50 index fund, Nifty Next 50 index fund, Nifty Mid Cap index fund, Small Cap index fund. In fact, you even have Nifty Micro Cap 250 index fund. So how do you select the best index fund category? Like I said earlier, in terms of return, there won't be a huge difference across categories. And you should also look at the risk aspect of investing. Considering that, a plain vanilla Nifty 50 or Nifty 100 index fund is good enough to fulfill all your long-term financial goals. You can invest in index fund from any mutual fund house that replicate that Nifty 50 or Nifty 100 index fund, because essentially all in mutual funds that replicate the same index of Nifty 50 and Nifty 100 would have similar risk return profile with a very minute difference. However, the only catch is Nifty 50 and Nifty 100 index does not give you the exposure in mid and small cap segment. That's where you have Nifty 500 index fund, where 65 to 70% exposure would be from large cap and remaining 30-35 would be from mid and small cap. So that can also be an option. But if you're someone who is looking for higher exposure in mid cap and small cap, you can explore Nifty large and mid cap 250 index. The best part of this index is that there's a 50% capping on exposure to large cap index. So your 50% money would be invested in top 100 large cap companies of India and remaining 50% in the 150 mid cap companies of India. So if I summarize, Nifty 50 or Nifty 100 has complete exposure in large cap, Nifty 500 has 65 to 70% exposure in large cap and remaining in mid and small cap, and Nifty large and mid cap 250 index has 50% exposure in large and 50% in mid cap. The only last thing I want to mention is index funds do not exactly replicate the index. Index fund returns are slightly lower than the index return itself due to tracking error. And it is due to expense ratio, or which is the fee of the fund manager. So that's first reason. Although this expense ratio is very low for index fund, it is still there. So this expense ratio results in small difference in return. And second reason is cash balance. Index fund managers never keep 100% of the money in index. They keep some 2 to 5% cash in liquid debt instrument to take care of redemption request. So it means when there's a sell request, they should honor that and give back the money to investor. Also, they keep getting inflows into their mutual fund, and sometimes it's not always possible to replicate the index in the exact same proportion. So if there's an exit or entry of new stock, they need to realign their index fund accordingly. Then sometimes there can be low liquidity for specific stock. Due to that, index fund manager might not invest in the same proportion as required by its weightage in the index. Hence, all these factors result in some sort of tracking error. Usually Nifty 50 index fund have lower tracking error as compared to say Nifty 500 or Nifty mid cap or Nifty small cap index. The reason is, you will see that Nifty 50 index has lower expense ratio as compared to Nifty 500 or other index. And second reason is, it's easy to manage top 50 or 100 stocks of large cap category as compared to say 500 stocks of Nifty. And there are cases where small caps have liquidity issue. That is the reason even if mid cap and small cap index may generate slightly higher return in the long run, it's not that easy for index fund to exactly replicate the performance due to tracking error. Hence, considering all these factors, the best index fund for investment is Nifty 50. If you still need exposure in mid or small cap, you can opt for Nifty large and mid cap 250 that gives you 50% exposure in large and mid cap each. While Nifty 50 has index fund by almost every AMC, there are very few index funds today that replicate Nifty large and mid cap 250 index. One is from Edelweiss, another I know is from Zerodha, and third is from ICICI Prudential. So this is it for this video. I genuinely believe that every person who wants to fulfill their long-term financial goal of retirement planning, child education, etc. must watch this video. There's still a lack of awareness among retail investors about the importance of index fund and challenges of active mutual funds. The problem is that active mutual funds are heavily marketed because they generate high business for mutual fund companies. Even the mutual fund distributors sell active mutual funds because they get high commission. And retail investors think that active mutual fund will outperform index big time. But that's not the case. Data clearly suggests that majority of active mutual funds struggle to beat the benchmark over the long term. So index funds should form a major chunk of your core portfolio of long-term investing. You can always have a few active mutual funds from FlexiCap, or let's say large and mid cap, or even for that matter mid cap or small cap as per your indulgence. But that should not form the major part of your portfolio. This is the most honest advice I can give you on YouTube or any online platform for that matter. And if you are still looking for some allocation in individual stocks, then you can check my weekly video series. Now please, if you find this video useful, then share it with every person in your family or friend circle so that people can get aware about why index fund should form the major part of their long-term portfolio. I'll see you next video. Till then, take care.